Hello everyone, my name is Christopher Cole. I'm here with Real Vision today in our offices of Artemis Capital, and it is my pleasure and honor to be interviewing an old friend of mine, Toby Carlisle, who is the founder and principal of the Acquirers Funds. And Toby is an expert on value investing and has written 4 books on the topic, which are really new classics in the field and should be read by any serious value investor. I'd like to introduce Real Vision to Toby Carlisle.
Thanks for the very kind introduction, Chris. So, I'm very happy to be here. I'm so happy to be doing it with you.
Yeah. Well, Toby, tell us about how did you get into value investing?
I was a mergers and acquisitions lawyer in Australia initially, and then in San Francisco. Went back to Australia to be general counsel of a public company that was a telecommunications company. I started work in 2000, right at the very top of the dot-com boom, saw the collapse, and then saw the emergence of this new breed of investors that were new to me. Nobody had really heard from these guys since the 80s, but they were, the guys who'd been doing the takeovers in the 80s had returned. They weren't known as activists at that stage. We didn't really have a name for them, but they were looking to get control of these busted dot-com businesses that had raised a whole lot of cash, had an enormous amount of cash burn. And it was hard to figure out what they saw in these businesses because I had read Security Analysis, the Graham and Dodd book, and I'd read Warren Buffett's letters. And he talks about looking for a wonderful company at a fair price. And these weren't wonderful companies at all. They were terrible companies, terrible businesses. But because they had raised so much cash, they traded down at a discount to their cash. These guys were looking to get control of the cash, then to either liquidate the company or use it to buy other companies. And that sort of period from early 2000 through to about 2007 was a golden age for value. Deep value guys coming through, activists, private equity firms taking companies private. And I just thought if that ever happens again, that the market gets cheap enough that strategy of buying sub-liquidation value companies, if that opportunity presents itself again, I'll take advantage of that and try and buy those companies. And so when the 2007-9 collapse occurred, I stopped working as a lawyer, set up a little fund, set up a little blog talking about buying these sub-liquidation value companies. And I just fell in love with the strategy and the process. And so I continued the research, wrote some books, and that's how I get to here.
So I think one of the most interesting things about your research is that there's so many individuals that follow the value investing framework. And I think everyone's knowledgeable with the canon of material out there, Securities Analysis, Benjamin Graham, but you've added some new twists to that through quantitative research. And I'm wondering if you could talk about that and how that plays into the concept of the Acquirers Fund.
Well, I think rather than adding too much of a new twist, what we've done is just revived some of the old ideas. So because Warren Buffett has been so successful and he's the avatar of value and he preaches this wonderful company at a fair price philosophy, many of today's value investors have similarly embraced that philosophy, and so they look for particular things: high returns on invested capital, moats, compounding type businesses that grow very rapidly, and then they're trying to buy at a fair price, which might be, say, a market multiple for a company that is better than that. That's one very small part of value investing. There's a much broader universe out there. The idea is simply that you're buying something for less than it's worth, and that's hard to do because most companies don't really trade at a big discount to what they're worth. The places where you find those big discounts is in financial distress, where an industry might be going through a down cycle. And so that is what I describe as deep value, where what we're trying to do is we might be trying to buy at a discount to balance sheet value. We might be trying to buy a cyclical company at the bottom of its cycle and then trying to buy at a further discount to that. And then we're hoping that there's an uplift in the way that the business performs. And then you also get the discount between the intrinsic value and the price closing. And so you have 2 ways to sort of make money. So we did some research. I did some research with Wes Gray, who was a PhD at Booth. We went and found every bit of industry and academic research that we could find that had been published from Graham onwards, so from the 30s onwards, and we tested that in a system to see what works what continues to work, what stopped working, what never worked. And so there are many things that were perhaps a product of data mining. So we looked at how do you identify a good credit? How do you find something that's financially strong? How do you identify earnings manipulation? How do you find statistical fraud? How do you find businesses that are very cheap and can grow and buy back stock? And the product of that research was a book called Quantitative Value. And I noticed this unusual phenomenon while we were doing it, that very undervalued companies behave in an unusual way, that sometimes the things that the less attractive the business, the better the performance of the stock, because they just get too cheap. And so nobody in their right mind would go and buy these things unless you can find some of these other indicia of value or quality in there. And so that was a book called Deep Value that came out in 2014, discussing the mechanics of mean reversion. And those mechanics are, simply there are private equity funds, there are activists who will come in and turn these companies around. There's also management in there not liking the performance of the company. They might be beholden to the industry cycle, and as other participants in the industry leave, the ones that remain can ask for higher prices for their services or for their goods, and so that they then get a period of very good performance. I just found that a fascinating kind of approach, and it's not one that is discussed much outside of Buffett. Buffett's sort of wonderful company at fair price. And so my research is sort of focused more on those type of businesses, and that's what the fund does. The fund tries to buy, we like balance sheet strength is great when we can find it. So we love a strong, healthy balance sheet, lots of cash flow coming into the business as well, lots of free cash flow. This is on the long side because we do run long short. We like the company to be buying back stock. I think that's a very powerful signal. It shows that there is that free cash flow there, that's genuine free cash flow. Management's thinking like you would want management to think, taking advantage of that undervalued stock price. And I think that when you see a material buyback, that also indicates that the stock is undervalued, because you see lots of buybacks through the cycle. Buybacks tend to peak at the top of the cycle, but they might be mopping up option issuance or just trying to goose the stock price at the very top of the cycle. That's not the kind of buyback that you want. You want material buybacks. So those things together on the long side, that's a pretty traditional. We're going to find we will own cyclical companies. We'll buy companies that it might be difficult to understand the reasons why we're buying them, because it might look like the business isn't a particularly good one. But we think with the combination of balance sheet strength and at the bottom of the cycle, it'll look like a healthier business going forward. On the short side, we're looking for somewhat of the reverse of that, something that's extremely overvalued to the extent that you can identify a value, because some of these companies, it's very hard. There may not be any value there at all. But they have, more importantly, they're in financial distress. There's some statistical earnings manipulation or statistical fraud. They have negative free cash flows. So the way that they're financing the business is by raising equity or selling debt. And that's a game that can go on until it sort of stops, until the market no longer lets you do that. And so we also look for broken momentum, because many of these companies will finance themselves by telling a great story, even though the financial statements don't reflect the narrative. The narrative is wildly diverged from the financial reality of the company. So that's what we like to find on the short side. Really compelling narrative, but none of that is being reflected in the financial statements. And so when the market starts seeing that too, and that momentum has gone or the momentum is broken, we'll take a short position. In the ordinary course, we hope to make a little bit of money on the short side, but the real function of the shorts are when the market collapses, they should provide more protection than their weight in the portfolio. And so you would hope through a 2000 or 2007 and 9 type scenario that it would perhaps prevent you from drawing down as much as the market.
So you found that there are certain quantitative metrics that are highly indicative of a quality value play. And maybe to talk a little bit about that and how that differs from some of the other viewpoints out there on the...
It's become much more popular, it's voguish now largely to ignore balance sheet quality. For a company to grow very rapidly, it helps it for it to be asset light. And they might run with very substantial amount of debt on the balance sheet, which when they're running up, that means that they run very fast and they'll go year after year performing very well. The problem is that it doesn't allow you for much in the way of, there's very little sort of ballast when you go the other way. So what I like is balance sheet strength. To the extent that we're using these statistical measures, it's not necessarily a new invention. I don't regard it necessarily as sort of, it's not like a NASA level analysis of the company. It's just, we're trying to find it's a sensible approach to doing it. But the reason we do it that way, rather than trying to be more discretionary and more ad hoc in our approach, is that we think that there are good behavioural reasons, and there's lots of research that indicates that a sort of more systematic, disciplined, quantitative, replicable approach to doing it means that through the bad times you're able to keep on functioning and doing what you should be doing, buying the right stuff. You don't swing for the fences, keep sizes of positions fairly small, consistently apply the approach, because every strategy has good times and bad times. And value has gone through a very rough time. So since the start of the year, if you track the factors that have done well, it's the factors that have done well for the last few years. Momentum's done very well. Growth has done very well. Value's done very badly. Quality has done very badly, which is ahistorical. Typically what happens is there's a value premium. You get a little bit more performance for buying these companies that are trading at a discount to intrinsic value, and that's not been the case.
Let's talk about that a little bit. It's really, really interesting because, I mean, I'm a volatility guy. You're a value guy. And years ago, we bonded back in Santa Monica.
Right.
Two completely different disciplines, but we share some things in common in the sense that value can perform during periods of market crisis.
Right.
And I'm curious for you to talk about a little bit about the history of value over the last 20, 30 years, how it performs in different market cycles, its defensive properties, and to answer this question, value's underperformed for 10 years. Is value investing dead? Is it dead, right? And to get your take on that, not that I believe that, but...
That's a question I get a lot. Is value dead? Can value come again? I don't know, but I can go back. So we have pretty good data on value back to 1951, point in time data to 1973. There are very distinct cycles through that entire period. So there are, over the full period, the outperformance for just a simple price to a fundamental, whether it be price to book or price to cash flow, enterprise value to cash flow, enterprise value to EBITDA, even price to earnings, very simple metrics. The outperformance to the low price to a fundamental, which is a reasonable proxy for a value stock, has been massive. And the growth side of that equation, where you're paying a higher price for that fundamental, has been pretty weak. And behaviourally, you might say, well, why would you pay that higher price? It's because the very best performers have always been expensive. So Walmart, through most of the time that it was listed, was always very expensive. Microsoft has mostly always been pretty expensive. The companies that you buy that have these lower prices to a fundamental tend to be junkier companies, cyclical companies. But you get paid to hold those companies. And so but you don't get paid all the time. You get paid over the full data series and the full cycle as well, because value performs various different ways through the cycle. From the bottom of a crash, value does spectacularly well. Value should provide some protection through a crash. At the tail end of a bull market, value looks terrible because the bid from value guys goes away. And the people who are fearless and who are prepared to pay increasingly higher prices will do very well through that tail end, but then there is some justice for those guys. There's typically a very significant crash to the momentum growth side through the cycle. There have been about 6 periods where value has underperformed materially. They're all were very well-known bull peaks. So the last one was 2000, in the run-up to the dot-com. Value performed very badly. They're all that covers, has Warren Buffett lost his magic?
So the Barron's one, right? Yeah.
And then value did then go on to perform pretty well for the early 2000s, but then it's been weak again. So it depends on how you measure value. So price to book value, that's the value factor. That's the academic definition of value. No practitioner uses price to book value, but that's the one that everybody points to because that's the one that the academics prefer because it's very simple to calculate and there are some good reasons. It's less volatile. The fundamental is less volatile where earnings is moving around. Book value is reasonably static from quarter to quarter. So it's a reasonable proxy. It really hasn't outperformed for 14 or 15 years. There are many reasons for that. Partially it's the composition of balance sheets has changed over time. There are companies out there that have bought back so much stock, they've actually got a negative book value. So it's very difficult for book value to categorize them as a value stock, even though if we would look at them on another measure, like a price to earnings, we would regard them as value stocks. So book value hasn't worked, but there's no practitioner who actually uses it. If you use an ensemble of measures that might be cash flow and earnings and sales even, that would have helped you keep up for the market for longer, but it's still failed sometime over the last 5 years. If you have some craftsmanship, which is what the more quantitative value guys describe as, their own mix that they use, where you might look at other things besides simple values. You might look at the quality of the balance sheet, the quality of the earnings. Do the cash flows match the reported earnings? Because that's important. You can have wild deviations where companies are reporting good earnings, but it's not reflected in cash flow generation. If you use all of those sort of measures, which is what most practitioners are doing, that kept up with the market and that outperformed pretty well until about the start of 2018. So since 2018, that hasn't worked very well. So that's a shorter period of time, and that's probably what most practitioners have seen, that it's been a period of weakness for value. There are pockets like that through the data series where that happens, and then immediately afterwards there is some very good performance for value. The thing that would make me nervous is if value was underperforming, but the portfolios as they're reformed at each rebalance date aren't reflecting the discount that we're seeing. But what has been happening is the value portfolios have been getting cheaper, so that the price ratios are wider. So what has happened now is that the most overvalued stocks are extremely overvalued, more overvalued than they have maybe been ever. The undervalued stocks are maybe at their long run mean, maybe a little bit rich to their long run mean. So I think at some stage, we don't necessarily have to have a crash. The cycle can just go back to value. But most likely what happens is that there's some sort of crash that resets the market. In the crash, what has happened when momentum and growth have run like this is that the downdraft has been massive for them. It's been to the tune of 80 or 90%. I think value could pull back a little bit. So I think that you want to be long short as a value guy going into the next crash to really see the outperformance, to maybe capture some outperformance on the way down, and then to be fully invested when the market finally does turn. I think it'll be a very good period for value from the bottom.
So it's such a powerful idea that in a late cycle, if we're entering into some sort of a late cycle secular change or some sort of a recession, value will drop like momentum stocks, but will drop less in a market correction. And that a long short, something that is short the momentum stocks, the hot stocks, the high flyers that have been making money, and long the inexpensive value stocks, that long short positioning will outperform and deliver alpha. And it's interesting too, because it also, even if you're just a macro guy and you don't pick stocks, right? I'm a volatility trader, so I don't pick any individual stocks, but I pay very close attention to the value momentum relationship. And any good macro investor should, because it is an interesting forward indicator to volatility. And I think it's very interesting that this last October, we saw one of the most violent reversals. At least when I was looking at the data, it was multiple days. There was one day I think it was a 6 standard deviation move. Another day there was a 3 standard deviation move. Truly wild moves where value dramatically rebounded against momentum stocks. And I mean, can you talk about how good that is as a signal to the macro investor community? Is that something that we should pay attention to? And what's your take on that recent reversal that has occurred over the last couple months?
So the thing that you're describing, the spread got very, very wide as it has ever been. Through August 27 was the bottom of that spread, and then it did start closing fractionally from August 27 through to September 9, which was then the biggest one-day move in value's favour since 2000, since sometime in the early 2000s. That's the 5 or 6 sigma move that you're referring to, which any quant nerd will tell you that it's not a normal distribution.
No.
So it's not a, but the point remains that it still was a very big move in value's favour, and it was a very bad day for momentum. And then it was followed up the next day by that 3 sigma move in value's favour and away from momentum. And then it was a very good September, October, November, December for value. So value outperformed the market through all of those months. It's softened up through January. It wasn't a great January, but wasn't a great January for value. Was a very good January for momentum. One of the best months for momentum in 20 years or something like that. So it's good to see those guys win one once in a while. I think that's what you would expect to see when there's a regime change. Very high volatility in the turn, because I think that's the way regimes change. You get that move, and that frightens folks who are in the momentum strategy. They realise there is some downside to that strategy because they haven't seen a lot of that. And I see that particularly in low volatility strategies. So low volatility wasn't something that I think folks had heard much about until a few years ago, 2 or 3 years ago. And I think it became very voguish a few years ago. And the reason why is pretty clear when you look at the data. Low volatility strategies typically do what they say they do. They don't go up as much as the market does when it goes up, but they don't go down as much as the market does when it goes down. Over the last 5 years, that's not been the case. It's materially outperformed.
So the low volatility, just for the viewers, low volatility describes strategies that effectively are herding into stocks that are low vol stocks, low beta stocks,
right.
In essence trying to use stocks as a replacement for maybe bonds.
I think that's right. Well, there's the joke doing the rounds now that you buy your bonds for the growth and you buy your equities for the yield,
Yeah.
Whereas that's not traditionally been the case.
Yeah.
And low volatility is a beneficiary of that, particularly because for that reason that you identify, I think that it regarded potentially as a bond replacement to the extent that equities further down the capital structure can do that. So I've looked at low volatility in relation to value, and I just ran this regression over the weekend because I was interested to see what does it look like. The notable times when low volatility has outperformed value, March 9, 2009 was the peak for low volatility relative to value in the last, say, decade or so. Reasons for that are very easy to understand. That was the bottom of the crash, and we performed very well at the other side of that. And then June 2, 2012, there was a little echo crash around that period of time. I don't know if folks remember that, but it looked like we might be going back into another crash. And I think that's when some of the QEs started again.
In 2012.
2012.
Right. So it looked like we began to see kind of outperformance of value during that period of time, and then they put on QE. They did QE3 at that point.
In 2013, the market had a very, very good year, and I remember discussing it with you at the time because it was a very good return for the market, but also a very low volatility year. So it was one of the best risk-adjusted returns on record, 2013. Now been replaced by some of the more recent years, but at the time that was a significant move.
In fact, I'll even say one of the best risk-adjusted years and one of the best risk-adjusted 3-year periods starting that year in 200 years worth of equity data for passive investing, right, over that period of time. Truly amazing.
So that was a good year. 2013 was a good year for the market. It was about a 30% year for the market, but it was a 60% year for value. It was a very good year for value too. It was really the last time that value did anything material. So values had, 2016 was a good year for value, but 2015 was a very weak year for value, and then 17, 18, 19 have been disasters for value, guys. And when I look at the data now, there's a very significant peak in the outperformance of low volatility strategies over value strategies. So what that has typically indicated in the past is that we're about to have a very good period for value in the near term and a weaker period for some of those other strategies. Volatility will almost certainly be a beneficiary of that too.
Yeah, it's interesting. But also maybe that a lot of these institutions that are crowding into low-vol stocks, maybe that low-vol stocks might underperform value based and might underperform people's expectations based on some of your analysis in that department?
Well, that would be my expectation, that value will materially outperform and low volatility will have a more difficult period. I would say that if you look at low volatility, they tend to be extremely expensive stocks at the moment, and the rebuttal to that is always that low volatility is not a strategy that depends on those stocks being cheap. But we've been through this very unusual period for this performance of volatility, low volatility, and so I think that there's been quite a lot of crowding into low volatility strategies, either consciously or unconsciously. I think that some of these stocks that have those very smooth returns do attract folks who perhaps are looking more at the price trajectory than the fundamentals of the business. And you can see that. You can pull up any chart, pull up the Microsoft chart, has that like the ski jump kind of path to it. Apple's chart has the same sort of ski jump look to it. Tesla's chart, after doing nothing for years and years, has had that five-fold increase in the last 6 months.
Stunning, yeah.
Who knows what the cause of that is? There are lots of theories about it at the moment. Maybe there are more shorts out there than we know about. That's one possibility. There's delta hedging in there's a lot of action in the options. Maybe they're delta hedging into the equity that keeps on pushing it up. But Tesla, I think, is a very good example. It's a weaker balance sheet. The financial statements aren't great for Tesla. There's no growth. It's 2% year-on-year revenue growth. They're selling more cars, but they're not selling them. They're not making as much money as they have in the past. It's a metal bender. It still has to create a factory to make these cars. It's not like software as a service where each marginal sale is virtually costless, and yet it moves like a software as a service stock.
To this point, this is interesting. It goes back to something you and I were talking about maybe a couple of weeks ago, where I think I was telling you the story of how I was in Switzerland, and we were going to a meeting, leaving Zurich to go to Pfefferkon. And my marketing guy is like, well, let's take an Uber. I'm like, no, it's going to be really expensive. We should take the train. Switzerland has one of the best train systems in the world. He's like, no, the Uber's cheaper. And I'm like, that's impossible. How is Uber cheaper than taking a train in Switzerland? And it was. And this isn't to go an hour and a half outside of Zurich. So the only rationale I have on that is that you have, I actually wanted to thank SoftBank for subsidizing my business trip, but effectively, what's your take on this where you have, they always say never go into business with a non-economic actor. That's probably why you and I don't own nightclubs, right? So in this mindset, if you have cheap money from central banks, they've lowered interest rates down to zero, and the big institutions of the world are throwing money at VC funds that are throwing money into these companies, and they don't care if they ever make a profit, and they're just looking for growth, in a frenzy for growth, and there's no assessment of value. Then other brick and mortar companies that are seeking to earn a profit and have to pay people and are actually looking to a long-term survival have to compete against these new disruptive technologies that are actually being subsidized by inexpensive money. To what point are central banks crowding out value investors?
That's a great question. I think that it's been a great time for consumers. There's been enormous consumer surplus subsidized by the VCs on Sand Hill Road, and that's been great for everybody. You get cheaper taxi rides, among other things. What drives that? Potentially that's too low interest rates making marginal business ventures look better than they would otherwise look. If your cost of money is virtually zero, then if you can get a return anywhere that's a little better than virtually zero cost of money, then that's a project that you should probably be investing in. So that's one of the problems, that interest rates being set too low or flooding the market with money creates that better businesses aren't rewarded for being better businesses. Being a careful husband of the cash on your balance sheet, that's not rewarded at all. Spending it to grow is rewarded. So the way that is reflected is in that duration trade where, the 30-year, when interest rates move, the 30-year moves a lot more than the 10-year. So the 10-year is more like a value stock, or value stocks are shorter duration because their cash flows are front-end loaded. You buy cheap cash flows now, perhaps expecting that there's not going to be as much growth, or there might be a little decline in the cash flows of the value stocks. Whereas the growth stocks, they're not earning any cash flows now. All of the cash flows are back-end loaded to the extent that they're going to make any cash flows at all, but that's the expectation. So when you move interest rates a little bit, you get wild moves from the growth stocks. You drop interest rates, you get wild moves up from the growth stocks. Value stocks don't tend to be as sensitive. So maybe interest rates need to go up for value to start working. I've heard that argument. I think that's a very good argument. The problem is that I think there are lots of really good arguments for why value hasn't worked, and there are some of them are going to be right in retrospect and some of them are going to be wrong. I think ultimately, as a value investor, you can overcomplicate things by trying to figure out the macro driving those side effects or those phenomena. And I think that you can simplify it as a value investor. You can simplify it for yourself by just working out if the individual company that you're looking at is in fact undervalued, and then looking at, to your point, are there non-economic, are there irrational actors who they're competing with? Sometimes that's a good thing. That's what creates the undervaluation. And then can that non-rational, non-economic actor survive, or will they be washed away eventually? I think that that's some of what we've seen over the last 5 years, that there's been an expectation that at some stage that flood of money that spigot will get turned off at some stage. And so you'll be rewarded for doing the analysis, looking at the balance sheet, looking at the strength of the business, the quality of the cash flows that it's generating, but not yet.
So it has a similar dynamic to, I would say, volatility, where you can suppress volatility, but the more you suppress it, you can suppress it for a long time, but the more you suppress it, the more it will realize itself in other ways and eventually come out even greater than before.
Well, you have the great analogy of burning back the tinder in the tall trees.
The sequoia forest.
The sequoia forest, and if you don't burn it back, that creates these explosive wildfires. And I think that's true also. That little bit of interest rate volatility or a little bit of higher rates sort of strengthens these companies. It makes them better companies, better businesses, better managements. And when they get fat and happy because there's the tinder's not being burnt back on a regular basis, that's when they set themselves up for a big crash at some stage.
It's the same concept. The longer the period of value underperformance, in essence, the greater the value proposition becomes on the other end of it for those who are patient.
Well, those who can survive too. You have to survive.
That's right, the business risk.
Because this is a problem. Value has sort of become a little bit of a laughing stock. There aren't very many traditional value guys around because it's so hard to maintain. It's hard to keep investors when you can get, for basis points, you can get access to the index, and the index is the best performing asset in the world. So then that makes any other active look pretty ugly, and particularly when any other active wants to charge a slightly higher fee. But again, that's ahistorical. It's not something that these trees don't grow to the sky. At some stage, there is that reckoning, and so I fully expect it to happen at some stage. I'm not predicting one in the short term or in the medium term. I'm not predicting one at all. The market, I think, if I've learned anything over the last decade or so, it's that the market is unpredictable and humbling at every stage, and so you never want to make a prediction about the future. But I would prefer to be, at this stage, in something like a value strategy than in the index or in low volatility or momentum, because I think that value is really the only thing that can provide returns over the next decade that are absolute or relatively better than anything else out there. I think everything else is going to have a very tough run over the next decade.
It was almost a decade ago, I remember, when someone asked us, there was a young kid who wanted to go on Wall Street, and somebody asked us to give him advice or something, so we took him out for drinks. I remember we sat down, and this poor kid, we were like, you need to go find the sector that is the most depressed sector imaginable, get into that sector, everyone will hate it, and by the time you're a vice president, you'll be the only person who knows anything about it, and the sector will be doing really well.
That's great advice.
It's great.
Why didn't we do that?
Right, exactly. But now you can't find any more two depressed sectors than value investing and or disciplines than value investing and volatility, long volatility trading.
Well, I think one of the things about value is that it's value's that movable feast. Value's always going to where the disaster is, or where nothing's happened for a long time. So value at the moment looks like it's pretty heavily into financials and energy. and miners and sort of heavy industry, which haven't done much for a long period of time. So we hold a lot of financials, and we've got some energy exposure too. Part of the underperformance of value has been that sector mismatch or the industry mismatch. So if you've been a value investor in technology, you would have outperformed any sort of naive market capitalization weighted implementation of that. The problem, if you're investing across every sector or every industry, is that you're more heavily weighted towards financials and other things that haven't done as well. Now, the financials, the reason for the underperformance is probably twofold. Interest rates are probably hurting financials, and the memories of 2007 to 2009 still very vivid in anybody who lived through that period, and so they're wary, and rightly so, of banks and insurers that could be hiding some sort of liability on their balance sheet that nobody knows about.
What's your take on, it's interesting because now everyone wants to go into passive investing, right? Big, large cap stocks, liquidity, large cap tech stocks, that's the rage, the FANGs. It is very similar or reminiscent to the Nifty 50s bubble in the 1960s, where essentially everyone crowded into these blue chip stocks. And those stocks, I want to get your opinion on that. And what's your view on that? And really, in terms of where do you see opportunity in the different market cap segments of value as well?
Every boom has this echo of other booms in the past. I think that, but there's always tech is always very sexy, whether it was electronics in the 60s, .coms in the 90s, and now it's software as a service.
Railroads.
That was a tech at one stage.
Yeah, it was a tech.
Right.
South Sea bubble, the colonies were a tech stock at the time, right?
People were worried about traveling on railroads because they thought that if you went faster than the speed of a horse, you'd be atomized, which is terrifying. But that's the sort of stuff. That's how technologically. That's the tech of the day. That's why it was so exciting for them at the time. The potential to be atomized, which probably there's a lot of value investors who'd like that right now. I think that every boom has some sort. You can draw analogies. They do look like other booms in the past, and I think that probably because they're driven by the same thing. There's some potential to invest in some life-changing or world-changing technology that seems to earn very high, maybe not very high profits, but seem to generate a lot of revenue or a lot of growth at least over a period of time. It looks like it's going to wash everything away that exists. I mean, that was the argument, the .com boom, right? These .coms are going to come in and they're going to wash away everything that's gone beforehand. Instead, what happens is all of the incumbents just adopt. If all you need to do is make a web page, or they just adopt those business practices, and the market goes back to the way that it was before, where everybody's competing pretty much on a level playing field, and that's a better period for value. The market seems to have, all of the performance in the market has been those very large cap tech stocks, but they have been, the ones that have performed very well have been ones that generated they have actually generated some profits and some very good revenues through. So Amazon, Facebook, Apple, less so Netflix, but Netflix is still growing at a very high rate. Google, if I didn't mention Google, but they are very profitable. They are very good businesses for the most part. And I don't think that they're expensive, but they're not extremely expensive. I think that some of the real overvaluation, the really egregious overvaluation is in some of those other. I think Netflix is more of that egregious overvaluation. Tesla certainly very egregious overvaluation.
So you talked about this tech effect, this idea that people, I hear this all the time among a lot of millennials, where it's different this time. The valuation's different this time. We've had a transformative change in technology. The iPhones have changed, the smartphones have changed everything. This is a new era for technology, and yet value investing has survived through the ages. Can you talk a little bit about is this a new era? Is this different? Has it changed, or will we seek a reversion of the mean in the same framework?
There are some compelling arguments for why things may have changed. I don't know that this is the first time that this has happened, but there may be changes in the market. So there is some parallels between, in the 1920s, when cars were sort of introduced and everybody got access to a car. there was a period of time where roads were built out, infrastructure for cars had to be built out, and that was a very bad period to be a value investor and a very good period to be sort of a more tech growth type investor, with cars being the tech of the day. And that lasted for about 16 years, and then value investing returned and did very well and has done pretty well through the whole period. So we may be looking at something like that where it's just maybe it is a little change in the structure of the economy, or there's a change in the structure of the market. I don't think that it means that value will stop working, and I don't think that it necessarily means that that change is a permanent change to the structure of the market. I just think that because the logic, I think, of value investing is so compelling. If you're buying something for less than it's worth, that should be recognised by the market over a period of time. Perhaps our definition of value has to change a little bit to keep up. So price to book value was the traditional metric for academics particularly. Some practitioners, maybe Walter Schloss was more of a book value investor, but I think that he did some other things on top of that as well. But he was more maybe like an early quant, where he'd have quite a diversified portfolio of low price to book value stocks. He did very well employing that sort of strategy. I still think you can do very well employing that sort of strategy. To the extent that there's underperformance now, it's pretty easily explained by the way that tech stocks are looking very sexy and they've run very well. A lot of investors look at the trajectory of the price only. So if something's gone up a lot, that's a reason to buy it, because that means that it will continue to go up into the future. Whereas value investors take the view that you have to look at the opportunity and buy it at a discount to the opportunity. All of those companies that have those sort of ski jump price returns, they almost invariably come back to earth. Not all of them have come back to earth yet, so I can't say that they always do, but excluding the ones in the current crop, that's always been the case in the past. They get to that point where they're vertically ramped, there's nowhere else to go, the weight brings them back to earth. And so I think that that's likely to happen to certain stocks, and I think that that's the precipitating event that leads to value then having a very good period where we all come back to our senses a little bit and try and buy fundamentals and cash flows. And we remember that, the function of business is to provide a service, to provide a product, to provide some sort of consumer surplus, but also to reward the shareholders in those businesses for putting capital at risk.
So we know, or we get a sense that that the outperformance of value, the rebound of value that we're seeing traditionally, has been a precursor to regime shift in markets, and that value has performed better at the end of a cycle, obviously, than growth and momentum. And that's in the deflationary sense. Let's just imagine that we end up having a very progressive government and an even more radical Fed than we have now. And there's widespread money printing, fiat devaluation, and we go into sort of a stagflationary crisis, reminiscent of maybe the 1970s. How does value perform in that type of environment?
How would the Fed be more radical than it currently is, just out of interest? But I think that sort of scenario.
Well, we might be surprised.
Yeah,
be careful what you
don't want to tempt the gods.
Don't tempt the gods, please.
Well, I think we're probably going to see it. So whatever you think,
whatever it is, yeah.
Every year is going to be weirder than the last, I think, for the foreseeable future. I think that that scenario is probably a very good one for value. Any sort of volatility is good for value. Anything that makes better balance sheets, more careful managements, better businesses perform better relatively to other companies that are out there will be good for value investors. So I think that higher interest rates, a tougher business environment, would certainly be a very good environment for value guys. I think that when we're in very low interest rates, lots of liquidity, and that's, it's hard to measure what impact that has on the business, because you see, if a venture capital firm invests in a tech company that then spends a lot of money on advertising, that money flows through to Facebook and to Google. And so where advertising-driven businesses used to be pretty cyclical, pretty boom-bust, they've looked more secular recently because there's been that move away from traditional television advertising to Google and Facebook, and so the cycle hasn't been as pronounced. It's certainly been pronounced for the traditional media. It hasn't looked so good for them. So I think that potentially very good for value, and I would love to see it.
It's interesting, as rates go up, volatility comes back into markets, and then the cost of capital is obviously much higher, and then I'm not getting a ride to Pathicon at half the cost of what it takes to take a train.
Right.
So I think that really kind of segues in. To that point, though, it's interesting, this idea. We think about this: is Google, Facebook, are these tech companies, or are they advertising companies, or in the component that used to be advertising agencies and more cyclical than we would think? The one question I want to leave you on, the FANG stocks. At what point will Tesla? What scenario? What point in history? When do you think will Tesla, Netflix, all these FANG stocks, Facebook, when will they become value stocks? When would you see that happening?
Well, I wouldn't say that almost every stock has its turn, has its regime come to an end. Buffett has been criticized in the past for not buying whatever is the fad of the day. But if you look at his history, he has tended to buy a lot of these companies that are better companies just after the crash, or after they stub their toe and they look a little bit less undefeatable. At the moment, it looks like Netflix can't be headed, Facebook can't be headed. But I think that the thing that created Facebook, for example, I think the kids don't like to be on the same platform as their parents or as the olds are. And so Instagram arises, Facebook sensibly buys Instagram, and so they're the beneficiary of being the owner of Instagram, where a lot of attention moved. I think attention moves away from Instagram now towards TikTok or something like that. So those companies, the growth slows, but they're probably still very good businesses. They're pretty low asset intensity, generate lots of free cash flow, reasonably stable, growing businesses. That's exactly the sort of thing that you would like to buy, but at a price. I don't want to pay for all of that speculative growth in them. If anything, I don't want to pay for the growth at all. I want to pay for them on their current earnings power, with maybe a little growth in there. Because if you do a statistical analysis on companies, the numbers that can sustain these very high rates of growth are very low. It's sort of 1 in 100, 1 in 200, which means that there's probably, there are 10 or 20 in the Russell 2000, so there are a few of them around. The problem is that everybody knows what they are, and so they are bid to the moon, and so you're basically betting on the fact now that they are in fact better than everybody thinks that they are. And I think that that's a very long bow at this point in the cycle. I think more likely people have overestimated what these things are worth, how far they can grow. They talk about the total addressable market for many of these businesses being enormous, but what they forget is that the total eventual supply is going to be pretty big too. Yeah. So there's going to be competition for those dollars. When the market moves, value investors have to move along with it. I think value sort of follows along behind the wave, but we're sort of picking up the detritus as it comes back. There just hasn't been a lot around, so it's been hard to find undervalued stocks. But I look forward to it, seeing it again.
It'll be like 2040. Google's regulated it's regulated and broken up.
Utility.
Like AT&T as a utility, and all of a sudden it's trading at some depressed PE multiple to whatever the next thing is.
Let's hope it doesn't take that long.
Exactly. Toby, it's been a pleasure. I know we've done this many times together outside, but this is fun to do this on a camera. So Toby Carlisle, Acquirers Fund. And Toby, where can people find you on Twitter and your website as well?
So I'm on Twitter at Greenbacked, which is a funny spelling. It's GREENBACKD. My fund is the Acquirers Fund, and the ticker is ZIG. It's listed on the NYSE. It's a long-short, net long to the tune of 80 or 100%, depending on where we are in the cycle. So we're about 80% exposed at the moment. We have some shorts in there too, and we tend to short, as I said before, the junkier companies. You can also find, I have a podcast and various other things on acquirersmultiple.com with a free screen. And I'm active on Twitter all day long, so I'm happy to engage, talk with anybody on Twitter.
And I guess we've got to show the viewers your daughter's bracelet.
Yeah, that's from my 6-year-old made that, so while I'm away, I can remember her.
So I think we can't end on anything better than that. So I
Thanks,
can't
Chris.
top that. Thank you.